So after understanding cash flows and inventory, and before that, we did understand balance sheet and income statement and the introduction of financial statements. Now we move to one of the section of the balance sheet that is non-current asset, also called long-lived asset. Long-lived asset, non-current asset, long-term asset, all mean the same. First of all, what are the long-term assets that we have in our balance sheet? Well, you have tangibles like property, plant, equipment, correct? Then you have intangibles. We are going to discuss about intangibles. Copyright, patent, trademark, franchise, franchisees, trademark, and goodwill, correct? Then you have financial assets, which includes investment in other companies' debt and equity for long term. And then you have deferred tax assets also. Out of this, financial assets held to maturity, available for sale, held for trading, this part we have already discussed in balance sheet. DTA and DTL we will discuss in taxes. Intangibles, to a larger extent, we also covered in balance sheet. So here we are going to talk more detail about the tangible assets, non-current. These are also called fixed assets, correct? So, like inventory, we have to now understand what cost of the asset will be capitalized and what will be expensed. Okay. So imagine a non-current asset of PPE like a machinery or an equipment. So when you buy the equipment, the cost of the machinery is recorded on the balance sheet, and all the expenses necessary to make the asset ready to use, like installation cost, transport to bring it to the factory or location, all of these costs, taxes, etc., all of these costs are capitalized. Okay, so whenever you buy an equipment, that goes into the balance sheet or income statement, the amount that you spend on the asset, what happens? We capitalize it, correct? Right? Everyone in the class? Subsequently, this amount then does come into the income statement, or it is expensed, but in the form of depreciation. So if the benefit is more than 1 year, we capitalize it, and later on it does come into the income statement in the form of depreciation if it's a tangible asset, or amortization if it's an intangible asset. Everyone with me on this? Correct? Okay. Now, balance sheet has assets, and these assets on the balance sheet are recorded at carrying value also. Carrying value is also called the book value of the asset. Carrying value or book value, both are the same. What is the book value? Historical cost minus accumulated depreciation. Accumulated depreciation is all the depreciation till date. This tells me the asset's balance sheet value or the book value or the carrying value, whatever you call it. Everyone with me? Now, like inventory, what is the difference of capitalizing and expensing with respect to PPE? So cost related to the PPE, either you capitalize or you expense. Now, this decision is with the management. But based on this decision, there will be impact on your financial statements. See, whenever I say capitalizing means, where do I put this cost into? Can anyone tell me? When I say capitalize means, this cost will go up into the balance sheet. Expense means goes to the income statement. See, if it directly goes into the income statement right now, immediately your profits will go down. Correct? If it goes into the income statement, your profits will go down. Right? But if you capitalize now, it does come into the income statement, but later on in the part of depreciation, in the form of depreciation. So capitalizing is actually pushing or delaying your expense recognitions. Understood? Pushing away. Capitalizing is delaying your expense recognition. And because you capitalize, you put on the balance sheet, what happens in the initial year? Note down this. In the initial year, the balance sheet value of your asset increases. And because you don't expense it, your it is not recognized as a loss in the income statement in the current year, or it is not recognized as an expense in the current year, right? Later on, it does come into the income statement in the form of depreciation. So later on your income statement, profit will go down. Right now, there will be no impact because we capitalize. Correct? Now, capitalizing and expensing. If you capitalize, you recognize it as an CFI outflow. So your CFI goes down. But later on, is there an effect on the cash flow? No, no. Exactly opposite will happen when you expense it. If you expense it, you recognize directly in the income statement. It is not recorded on the balance sheet. So on the balance sheet, there is no recognition now and therefore no impact if you expense it. But on the income statement, your profits will go down because you recognize the entire expense right now. Later on, there is no impact. And since you recognize that as an expense, it is considered as an operating cash outflow, and therefore your CFO goes down. This is the effect of capitalizing versus expensing, or expensing versus capitalizing. But if you want to see the effect of both simultaneously, this is the most important table. Everyone. Conclusion, balance sheet means delaying the recognition of expense. Right now, recognizing that on the balance sheet. Capitalizing means right now recognizing that on the balance sheet. Expensing means right now recognizing that directly into the income statement. So everyone in the class, tell me, your focus first should be on capitalizing. Okay, opposite will happen for expensing. If you capitalize right now, what will happen to your income statement? Will there be anything recognized in the income statement right now? No. If your income statement, if nothing is recognized in your income statement, what will happen? Your profits will be higher. So all the profitability ratios, all the ratios where there is profit or net income on the numerator, whether it is ROE or interest coverage, where you have EBIT on the top, they will be higher. And when you capitalize, you smooth your expenses. Why? Because you don't put anything right now in the income statement. Later on, it comes in the form of depreciation in a smoother way. So your income variability is lower. And your profits are compared to expensing, your profits are, everyone in the class, your profits are higher initially. If your profits are higher, what will happen? Your shareholders' equity will also be higher, and therefore debt equity ratio, where equity is in the denominator, will be lower. Correct? And since you capitalize, your total assets are higher, and therefore debt ratio, where the denominator there is asset, that ratio will be lower because of the higher denominator. Now, when I capitalize it, I consider it as a CFI. So my CFI will be lower compared to my CFO, which will be higher. Understood this? Clear? But remember, all of this effect will be in the first year. Later on, it will all reverse, because later on, there is no effect of expensing, but capitalizing does come into the income statement in the form of depreciation. So your net income, ROE, and coverage, interest coverage, were higher in the first year. Later on, they will be lower because of depreciation. This is what will happen with capitalizing, exactly opposite with expensing. In expensing, right now, your balance sheet values will be relative to the capitalizing will be lower, right? Your expenses will be high, so your profitability will be lower, and therefore all the ratios related to debt to equity or debt to asset, because the denominator is low, the ratios will look higher. However, later on there will be no effect, so later on that coverage ratio and net income will be relatively higher. Understood? This is very crucial. Capitalizing means delaying your recognition of expenses, putting up into the balance sheet. Expensing means doing it right away in the income statement. Is this clear? Everyone in the class? Understood? Now, let us understand depreciation. First of all, there are two forms of depreciation now in your syllabus. Initially, there were three. There was something called units of production. Now you need to focus on two forms of depreciation: straight line method, SLM. Straight line is the historical cost minus the estimated residual value over estimated useful life. Remember, residual value and useful life, you cannot guarantee it right now. These both are estimated. Got it? Understood? SLM depreciation every year will be same or different? SLM depreciation every year has to be same, correct? Contrary to that, double declining depreciation. Double declining depreciation means the depreciation is twice. Here, there is a formula of double declining, but I would want to write a note and so that you all understand this. Use calculator function only. You don't need to remember the formula. I've put here the formula, but guys, you don't need to remember the formula. You need to use the calculator function only. What is the calculator function? I will show you it in a moment. Okay. So let's assume first for SLM depreciation. For SLM depreciation, imagine the cost at which you purchase the asset was 110,000. Okay. The estimated life of the asset, imagine was 5 years, right? And the estimated salvage, what is salvage? Is the residual value that you get when you sell the asset. Imagine it is 10,000. So how will I calculate my SLM depreciation, everyone in the class? My SLM depreciation will be cost minus salvage over estimated life. So 110 minus 10 over 5. This is going to be how much? 20,000 will be my depreciation per year. Everyone with me in the class? Understood? Correct, 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 correct. Okay. Now, guys, here my depreciation expense each year will be how much? 20,000. What is the gross value of my asset? 110,000. Understood? Clear? Most of the cases, they will give you the salvage. What if there is no salvage? And what if I want to make it easier for you? Suppose there was no salvage. So let me take, for easy calculation, let me take the cost as 100,000. Let us take the salvage as 0. Assume there is no salvage. Okay. Then 100,000 divided by 5 will be my depreciation expense per year. Got it? Everyone? Now, this I did it to help you understand how to derive the life of the asset. So imagine this situation, okay? Imagine this situation, everyone, and tell me what is the total useful life that I've given you already? Hello, can you hear me, everyone? Can you hear me? Check, 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 check. Okay. The total useful life I've given 5 years, right? Now, the alternate way to derive the total useful life is take the gross PPE, means the cost, and divide it by depreciation expense, that is 20,000. So if the gross PPE is 100,000, okay, in my case, it was 100,000 year, and the depreciation expense per year is 20,000, that will give me total useful life. Understood, everyone? But what if I tell you that the accumulated depreciation till this year is 60,000? So how much have I depreciated till now? 60,000. And what is my per year depreciation? 20,000. So 60 over 20, this will tell me that how much is the age of the equipment. How many years have passed? Isn't it? What is average age? What is average age? Accumulated depreciation over depreciation expense. Everyone clear with this? So total useful life of the asset is 5 years. Average age is 3 years. As of now, it's 3 years. So how many years remain? 2 years. How did I get 2 years? Net PP. What is net PP, guys? Net PP is nothing but the gross PP minus accumulated depreciation, which is what we call as the carrying value. So that is 100 minus 60 accumulated depreciation, that is 40. 40 divided by per year depreciation of 20 gives me the balance life, that is 2 years. Everyone understands this equation? total useful life, average age, and remaining life. Gross PPE is also called the historical cost. Accumulated depreciation is the total depreciation till date on the asset. And the net PPE is nothing but the carrying value, that is gross minus accumulated. Is this clear, everyone in the class? Check, check, check. Let me know first. Hello? Can the class hear me? Hello, 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 hello. Yeah. Okay. Now, which of the depreciation will have higher depreciation initially? Who will have higher depreciation? As the name suggests, double declining. So, double declining will have initially higher depreciation compared to SLM. Later on, of course, this will reverse. Why? Because the total depreciation has to be the same, isn't it? So, since double declining has a higher depreciation initially, right? Its profitability will be lower initially and later on it will reverse, so it will be higher. Opposite will happen for SLM. Now, do you think managements play with this depreciation and can manipulate the numbers? Yes, because I told you there are two things in the calculation of depreciation that are estimated. The residual value and the useful life is in the hands of the management. What if you increase the residual value? What will happen to the depreciation per year? If you increase the residual value, the depreciation per year will go down. Similarly, if you increase the useful life, the depreciation per year or depreciation expense will go down. Are you getting it, everyone in the class? So, the effect of choice of useful life and salvage does play an impact. Means if you increase the, sorry, if you increase the estimated useful life and salvage, what will happen? If you increase both, your depreciation per year will be low. But if you reduce both, your depreciation will be higher. Understood this part? This part is different from the other part. Is this clear, everyone in the class? How the choice of depreciation does affect your income statement? So if you have a higher, how the choice of, not depreciation, how the choice of estimation of useful life and salvage will have an impact on your income statement. So if you use a higher useful life and salvage, what will happen? The depreciation will be low, correct? And the profits will be higher. If you do the opposite, the depreciation will be high. This is in the hands of management and therefore they can play with this. Is this clear, everyone? Got it? Everyone in the class? Understood? Check, check, check. Okay. Yes. Now, something which is not there in your notes, let me tell you that, is that when you record an asset on the balance sheet, there are two ways of doing so. One is a cost model and second is a revaluation model. Cost model means recording the asset on the balance sheet at carrying value. We all know what is carrying value? Historical cost minus accumulated depreciation. Every year, the depreciation amount will keep on accumulating more and more. So do you think under the cost model, the asset price will always go down or can go up? Under the cost model, the assets value will always go down year on year or it can also go up under the cost model. Well, under the cost model, it will always go down because accumulated depreciation will keep on increasing, right? So here, assets value will always keep on decreasing because we take the base as the historical cost, right? But that won't happen in a revaluation model. In a revaluation model, we carry the assets on the balance sheet at fair value. Therefore, the assets value might be higher or lower than the historical cost because we are doing it at fair value. So which of the method is allowed and not allowed? Well, IFRS being flexible allows both the method, but US GAAP being rigid allows only the cost model. It is required. It's not a choice. And in IFRS also, companies generally prefer cost model. Why cost model? Because otherwise you will have to find the values of the assets every year. To avoid that headache, the asset's historical cost is always taken in most of the cases. It is always taken in US GAAP, in IFRS also, that is being preferred. So companies for long-lived asset generally use which model? Cost model. However, they can also use revaluation model. Everyone, oh, but also only in the case of IFRS. Understood? Everyone? Check, check, check. Clear? So our focus, the common is cost model. Clear? Okay. Now, see, when you buy the asset, you have to decide how to capitalize an expense, then you have to depreciate the asset, then you have to put the asset on the balance sheet as per the cost or the revaluation model. What if the asset's value falls so much that it is difficult to recover? So, an unexpected decline in the value of asset is what we call as impairment of asset. Impairment is very much similar to write down that we saw in inventory. Remember in inventory, we had something called write down, correct? When the value of the inventory goes down. Similarly, when the value of the balance sheet asset goes down, we call it as impairment. It's decline in the value of asset. Is this a gain or loss? Ever in the class? Like write down, impairment is a loss. So this loss is recognized in the income statement and the assets value goes down. Impairment losses are recognized when the assets carrying value is not recoverable. Not recoverable means you do not expect asset to come back to its carrying value. So very, very important, these three things. Based on the impairment, what is the effect on income statement, balance sheet, and cash flow? First of all, impairment is a loss. So income statement loss is recognized. On the balance sheet, the assets value goes down. Fair value minus selling cost. That is what the assets value on the balance sheet is. That will go down with the impairment loss. So assets value is written down. Like inventory is written down, asset value is written down due to impairment loss. But is impairment a cash outflow? No. Cash flow, there is no effect because impairment is not real. It's notional. So it's not an actual loss. Like depreciation, write down, amortization, impairment is also non-cash. So there is no effect on the cash. Everyone with me on this? Clear, clear, clear. There is a very, very, very high chance of a question surely on impairment. Understood? Especially the criteria of impairment. This is slightly tricky. So I would want everyone to have an eye here and carefully, understand this. I don't expect those who are seeing it for the first time to memorize it immediately. Those who have already seen it, they might connect it. Okay. So take your time. Now, IFRS and US GAAP have different treatment of impairment altogether. In IFRS generally it is tested annually. In US GAAP, it is based on some specific event. Now, what is the condition of impairment? The condition of impairment is that the asset's carrying value is something, but its market or recoverable value has dropped substantially. So what is the condition of impairment? If the carrying value is greater than recoverable amount under IFRS. Recoverable amount, everyone? Now, what is recoverable amount? Suppose you have a car, example, okay, an easy example. Suppose if you have a car and let's say in the recent floods, the car has completely damaged such that its carrying value is also not achievable. So imagine the car's carrying value is 100,000, but you are hardly going to, you are hardly expecting only 60,000 to come back. So this 40,000 is recognized as an impairment loss, carrying value minus recoverable amount. But the question is, what is recoverable amount? Tell me one thing, if the car is damaged, it's in working condition, but not that great anymore. You have two choices. Either sell the car right now in the market. If you sell it, you will get fair value minus selling cost, that is NRV, net realizable value, or you continue using it. If you continue using it, you'll generate some savings or cash flow. Present value of all of that is called value in use. Now tell me something. If you immediately sell, let's say you'll get If you immediately sell, you'll get 60,000. But if you continue to use it, the present value of all of that is 55,000. Which one will you choose? Will you immediately sell at 60? Or if you continue to use, you'll get the present value as 55. Which option will you choose? Well, you will always choose the higher, right? So the higher of two is called my recoverable amount. Understood? The higher of two is called my recoverable amount. But remember, I gave you the example that my carrying value was 100. So guys, my carrying value was still higher than the recoverable amount of 60. That means this difference of 100 minus 60, that will be my impairment loss. Understood? Everyone in the class? IFRS being flexible in inventory, remember IFRS, does the IFRS allow reversal? Does the IFRS allow reversal? Yes, but only till previous loss. Same way here in impairment also IFRS allows the reversal, but only till the previous loss. Everyone with me understood the concept of impairment? Check, 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 check. Why it is higher of both? Clear? All these numbers will be provided to you in the exam. You do not have to calculate anything. They'll provide you. All the numbers they'll provide you. US GAAP has slightly different thing. In US GAAP, you know how US GAAP is. Instead of directly saying carrying value and recoverable amount, they have a two-step process. Number one step is which is called recoverability test, where you compare the carrying value with undiscounted future cash flow, not discounted. If they were discounted, it would be value in use. Value in use is discounted. No, they say undiscounted, without time value of money. This number will be provided to you. You'll compare them, and if the carrying value is higher, then you go to the step 2 of measurement of loss. In measurement of loss, we take the carrying value and compare it with the fair value. Not fair value minus selling cost, only fair value. That difference is called my impairment loss. But what if there is no fair value in the market? If there is no fair value in the market, if no, only then you can use value in use, like what you did for IFRS. But since you have fair value, you can use that. Understood? US GAAP is a two-step process, a very different process. Does US GAAP allow reversal? Remember, in inventory write-down, did the US GAAP allow reversal? No, US GAAP did not. Here also, US GAAP does not allow reversal for assets which are held for use, which means asset which we are going to use. But asset which you are not planning to use, held for sale, they can be reversed. Same like IFRS, still previous loss. Remember, in your balance sheet, you have two types of assets. Asset that you're going to continue to use, asset that you're planning to sell off. Those assets that you're planning to sell off, their treatment is like IFRS, but generally, if you have mostly you have assets which are held for use, in that case, US GAAP does not allow reversal. We'll see a couple of questions regarding impairment. Very interesting. And I expect for sure something to come in exam on impairment. Right? I've put your additional information. This information, if you want, you can learn it. You want, you can write it down. If not, it's okay. What is important of this, I have put here. See, of all the information here, I've put what is the frequency of impairment. One thing that you need to know is the intangible asset. See, there are two types of intangible asset. One with finite life, like patent, trademark, franchisee, they all have a finite life. Okay. Finite life, hence they are amortized. If there is something, see, depreciation is what a word that we use for, it's a word that we use for tangible asset. For intangible asset, we use amortization. Now, when I want to do amortization, right, the asset should have a life. Copyright, patent, trademark, they all have a life, finite life. So I can amortize them. But there is one intangible asset which does not have a life, indefinite life. Can you tell me which one? The asset which does not have a life is goodwill. Goodwill is not amortized but tested for impairment at least annually. All I want you all to is to highlight this. Goodwill is not amortized, but tested for impairment, that too annually. Everyone with me? Clear? Okay. One last thing that you need to know, that suppose a company has two types of asset which it is going to use, and asset which is it is planning to sell off. Asset which you're planning to sell off, you need to first test them for impairment and reclassify them from asset held for sale, asset held for use to asset held for selling. That reclassification is necessary. While doing the reclassification, you need to do two things. First, you need to test them for impairment, and second, no depreciation or amortization is henceforth applicable to assets that you're planning to sell. Understood? Two things. Test it for impairment when you're reclassifying, and stop depreciating or amortizing them. Is that clear? Okay. Right. Finally, when you are done with the asset, you want to get rid of the asset. So you derecognize. Derecognize means you remove the asset from the balance sheet. There are three ways to derecognize. Either you sell it off, exchange, or abandon. Okay. Now focus here on sale and abandon. They both are similar. You know why? Because see, suppose there is an old asset which you're planning to sell off, or let's say you sold it. What is the balance sheet effect? You remove the asset from the balance sheet and you compare the carrying value with the selling price. The difference can be recognized as a gain or loss in the income statement. Correct? But if you abandon, again, you remove the asset from the balance sheet, right? Asset is reduced for whatever the carrying value is. You remove it from the balance sheet. And when you abandon, do you get anything? When you abandon it, do you get anything? No, you don't get anything. So in abandonment, the entire carrying value is recognized as a loss if there is any carrying value. If the carrying value has become zero, there is no loss. But if there is some carrying value and you are abandoning it, that entire carrying value is recognized as a loss. Understood? This is the sale and abandonment. Abandonment is also like sale, but with a value of zero. Then you have an option of exchange. Exchange is where you replace the carrying value of older asset that you've given up with the fair value of the new asset. This is the effect on balance sheet. And the difference between the fair value recognized and the carrying value is your gain or loss. So the difference between the assets that is going out, that is a carrying value, and the asset that is coming in, that is a fair value, the difference of the asset's fair value and carrying value is recognized as a gain or loss. Understood, everyone? This is the last part. See, first we understood capitalizing and expensing when the asset comes in, then you depreciate, straight line, double declining, then you record it on the balance sheet at cost model or revaluation model, then you impair them, and finally you derecognize them. The entire journey of the asset. Understood? Now they added couple of more things here, right? Which I will discuss, especially spin-off. But before spin-off, let me tell you about disclosures and presentation because that is related to what we studied. Disclosure and presentations are put up in the footnotes. Okay. There are many differences for the assets under IFRS as well as US GAAP. Here I have highlighted some of them which are very important and common for both. What are the common? You need to know the carrying value of all the assets. For each asset class, you need to know the carrying value. Accumulated depreciation or amortization information is needed, like inventory, where the inventory which was pledged as collateral for borrowing. Same way here, some of the assets might be put up as a collateral for mortgage or borrowing. So any restrictions of title or etc. on the assets that are pledged, I need to know that in the disclosure. Then all the related stuff about impairment, like what is the impairment loss, what are the circumstances that caused for impairment, same like write down. What are the circumstances that caused write down, correct? For revalued asset under IFRS, what is the revaluation date, how the revaluation was carried on. See, remember, revaluation model is only for IFRS. US GAAP doesn't allow revaluation. Understood? But the last disclosure is very crucial because it has a number. Under US GAAP, the disclosure requirement for intangible assets are similar to PPE. And in addition, the firm must provide an estimation of the amortization expense for the next 5 years. This is one of the disclosures that I have shortlisted as important. Why? Because under US GAAP, the future 5 years amortization expense need or estimation of that also needs to be added. So the firm must provide the estimation of the amortization on intangibles under US GAAP for the next 5 years. Understood? Clear? Okay. Now let's understand the concept of spin-off. Okay. Here, let me give you an example of a parent company and a subsidiary company. Now, let's say ADNOC, the main company, is a parent company and it has a subsidiary called ADNOC Gas. Okay. Now, suppose initially there was only one business, ADNOC. Okay. Sorry. There was only one business under ADNOC, which included oil, gas, everything. So now they decided to spin off. Spin off means split the company and spin off a separate business. So what will ADNOC do? ADNOC is a parent company. ADNOC Gas is a subsidiary. ADNOC will transfer all the assets to the new entity. Am I correct? Correct. That new entity is called Spinny. And ADNOC, the transferor, the parent company, is called Spinner. Understood? Spinner and Spinny. So ADNOC is Spinner, ADNOC Gas is Spinny. So I'll repeat. What will happen when there is a spin-off? ADNOC is trying to create a separate company of ADNOC Gas altogether, right? So what will ADNOC do? ADNOC will transfer all the assets related to ADNOC Gas, that is Spinny, into a new legal entity. But who's the owner of that new legal entity? Well, the shares of Spinny are transferred to the spinner, ADNOC. Will ADNOC pay for it? No, it's ADNOC's own company. So these shares are transferred for free. Everyone with me? Understood the first 2 points? How the spin-off works? All the assets related to ADNOC Gas are put up into a separate legal entity, and the shareholder of ADNOC Gas is ADNOC itself, the spinner, but for free. After the split or after the spin-off, shareholders of spinner, that is ADNOC, now have two shares, two different shareholdings. They are the shareholder of the spinner as well as the spinny, that is of both the companies. Understood? Clear? Now, whenever the spin-off is decided or finalized, once the spin-off is probable, the balance sheet assets and liability of the spinny, that is ADNOC Gas, will have to be transferred from ADNOC, right? So ADNOC should reclassify these assets before transferring. How do they reclassify? Instead of saying asset held for use, now they will reclassify them as asset held for not sale, but asset held for distribution. Why? Because sale is profitable, distribution is free. So I will reclassify the asset. Like I showed you, you need to reclassify the asset. So I will reclassify the asset from asset held for sale. I means the spinner, ADNOC, will reclassify the asset as asset held for use to asset held for distribution. Under this transaction, will there be a gain loss to either of the companies? In spin-off, is there a gain loss? No, there is no profit and loss to either of the companies. So there is nothing which is recognized in the income statement because you are splitting your own company. Is this clear, everyone? Understood? Right? Let us do some questions now. Okay. Wait a minute. Okay. So, number one, everyone should respond. Okay. I don't see many people responding. The average age of the firm's PPE can be estimated. Age, how many years till now? See, average age is accumulated depreciation divided by depreciation expense. That will tell me how many years have been depreciated till date, right? So it is accumulated depreciation divided by depreciation expense. A is the answer, everyone. Right? Before I do it here, everyone should also put up in the chat box. Clear, clear, clear. Okay. Second question is very interesting. Let me see how many of you all answer. Okay. Marshall is a large manufacturing company based in US, but also operating in several European countries. It has long-lived assets currently in the use that are valued on the balance sheet at 600. So the balance sheet value of the asset is 600. This includes previously recognized impairment loss of 80. Original cost was 750. The fair value is appraised to be 690. So market value of the asset has increased. Does it matter in terms of US if it's a US GAAP? See, have they said US GAAP or IFRS? They said it is US GAAP. In US GAAP, whatever is the fair value, we are least bothered of it. Why? Because we only use the cost model. Clear? And as per the cost model, the balance sheet value is 600. Even though the fair value has become 690. Assuming that Marshall reports under US GAAP, the new appraisal of the assets value will most likely result in. So they said there was a 600 million, and at that time you had recognized a loss of 80. Now the value has gone up to 690. Should I revalue? No, I cannot. For asset which is held for use, reversal of write down, is it allowed? No, US GAAP does not allow reversal of write down. So there will be no change in the financial statement. Everyone with me? So once the value is gone down, done. Now you cannot reverse it back in the future. That is not possible under the cost model. And also, even if you have done impairment, reversal of impairment is not allowed under US GAAP. Is this clear, everyone? Right? The other choices are just for a trap. Got it? Everyone? Yes. Taking an impairment of long-lived asset will result in, what is the effect of impairment, guys? Impairment is a loss. Okay, so what is the effect? Lower debt to equity ratio. See, impairment is a loss. So what happens in debt to equity ratio? Loss means your equity goes down. So your debt to equity ratio actually increases. So that's wrong. Higher DTL, higher deferred tax liability. No, there's no effect on DTL. Higher future ROA. ROA, return on asset, is net income, let's say, over total assets. Now, when I do the impairment in the current year, the value will go down. Later on, what will happen? Later on, what will happen? The assets value has gone down when I do the impairment, right? So the depreciation is going to be less. Because the depreciation will be less, the assets value will fall less. And because the depreciation is less, right, what will happen? My net income will fall less in the next year comparatively. So because my net income will fall less. And why? Because of lower depreciation, my future ROA will be higher relatively. Understood? Why? I'll repeat. Because when you impair, the asset value goes down. So the depreciation next year will also be low. Correct? Depreciation less means more profits. Everyone with me? Clear? Next. Company reports under US GAAP. Company has begun long-term project to develop inventory control software for external use. Do you remember what we did in balance sheet? Software for sale. Okay, under US GAAP, software for sale has a similar treatment as IFRS. Before technical feasibility, what do? You expense it. Later on, once the technical feasibility has reached, you capitalize it. This treatment is same under IFRS and US GAAP, both for software for sale. For research and development, they had a different treatment. Correct? So on the financial statement, Mammoth should capitalize all, expense all, no. Expense, capitalize all the cost of the project, expense all the cost, expense all the cost of project until technological feasibility is established. Am I correct? Because once it has been established, after that, what do? I capitalize. Clear? Understood? This was related to balance sheet. See, balance sheet and long-lived asset, they mix the question because it's the same thing. Next, when comparing the financial statement effects of expensing versus capitalizing and expenditure, capitalizing, focus is on capitalizing, will most likely result in which of the following effects in the years after the expenditure is incurred? So, capitalizing will have what effect compared to expensing? This is what we have to discuss. Capitalizing will incur in lower net income and higher ROA. Capitalizing will have lower net income or higher net income? Higher net income, isn't it? Higher net income, correct. And lower ROA. Lower ROA. See, capitalizing is smoothing. Capitalizing means my net income. My net income. And see, very interesting. They are not talking in the current year. They are talking in the following effects in the years after the expenditure is recognized. See, right now when you capitalize, compared to expensing, the effect on the income statement is less. So right now in capitalizing, the profits are more now. Later on, depreciation will be there, but in expenses, there will be nothing. So because of depreciation later on, the net income will be lower in the following years. So the choice is between A and C. Let me see. Net income will be lower. And what about the assets value? The assets value will also be lower because of depreciation later on. So because of depreciation, what will happen? My net income will go down, correct? And in case of ROA, which is net income over assets, total assets, right? What will happen? Later on, my depreciation will exist in the next year, correct? But the assets value will also drop, and the assets value will drop further. So what will happen? When I capitalize something, the assets value increases compared to expensing because of the denominator being higher. What will happen? And the net income will be lower due to depreciation. Both will result in my ROE increasing or decreasing. Sorry, both will result in ROE will fall down. So the answer is C, not A. ROA. See, ROA won't be higher. Why? Because the assets value will be higher because of capitalizing compared to expensing, and the net income will keep on going down next year also because of depreciation. So overall, your ROA will fall. It is tricky one. Understood? Correct? Well, that's the end of a sort of a difficult topic of long-lived asset. Now we move to long-term liabilities and equity. Okay. Okay. Long-term liability and equity. In this topic, we are going to talk about the long-term liabilities and some section of equity. Basically, long-term liability. What are the long-term liabilities of the company? Debt, bond, long-term lease, pension, or deferred tax liability. These are long-term liabilities. Fortunately or unfortunately, they've removed bond from this segment because they think that bond is anyways discussed in detail in fixed income. So they don't discuss anything about bonds here. All they discuss is about lease and pension only, because for DTL, you have a separate topic of taxes. So in this topic about long-term liabilities, we are going to first discuss about lease, then about pension, and then some discussion about share-based compensation related to equity. First of all, leasing is a form of, it's an alternate to borrowing and buying. So those who cannot afford to buy an asset, they go for leasing. Leasing releases your capital isn't blocked. So leasing is considered as a form of financing that enables lessee. Lessee is the one who takes the asset on lease, and the one who gives the asset is called lessor, right? It enables the lessee to finance the purchase of the asset, purchase or use of a leased asset. Now, there are two types of lease. Okay. Number one, See, first of all, I'll repeat, why do I lease? Because I don't have money to buy the asset. So I consider leasing it. Okay. Okay. So we are understanding the two forms of leasing now. First of all, why do I lease? I do the leasing. Why? Because I am not going to buy the asset. So leasing is an alternate to buying the asset. Leasing is better than purchasing the asset. Why? Because of few reasons, like less initial cash outflow. So you don't have to do down payment like you buy the asset. Less costly financing. Yes, sometimes the cost of lease is much lower than borrowing. Now, that's not the case in every country. I disagree with this. In some country, the rents are much higher than the cost of borrowing. In some country, the cost of borrowing is much higher than the rent. So this fluctuates quite a lot, but since it's a syllabus based on US, so we consider leasing is sometimes less costly to finance. And no risk of obsolescence means you do not worry about what happens to the asset. That obsolete, the asset becoming obsolete is not a risk anymore in leasing. It's not your headache. Correct? Now there are two types of leasing. As I said, finance lease and operating lease. Now, after years of fighting between IFRS and US GAAP, finally they came up to a common parity as to the definition of what is finance and what is operating lease. So if you meet any of the below 5 conditions, yes, I'll repeat, any of the below 5 condition, then it's a finance lease. If not, then it's an operating lease. This is very important. What are the 5 conditions? Okay. Number one, at the end of the lease period, the asset should transfer to the lessee, or the lessee at least should have the choice. If not automatically, the lessee should have the option to buy, and it is expected to buy. So at the end of the lease term, the asset automatically goes to the lessee, or the lessee has the option to buy and he or she exercises it. These are the first two. And remember, any of the 5 conditions you meet, it's a finance lease. Third, lease term is for most of the asset's useful life. Imagine the asset's life is 5 years and your lease term is 4.5 or more. There's no number given here, okay? How much should be most? When they say most of the life means they haven't given the number. But if you're using for more than 5.5 years or approximately, then you're using asset for most of the time, right? Then it is called financing. Also, very important, the present value of all the lease payments. Suppose total present value you pay of all the lease of the next 5 years is 100. This, if it is greater than or equal to the asset's fair value, greater than or equal to, not less than, okay? Then also it's a finance lease because you're paying most of the money of the asset. And finally, if after using the asset by lessee, if the asset is useless for the lessor, it has no use for the lessor, then it is called finance lease. Any of the 5 conditions you meet, it's a finance lease. Everyone with me? Understood? Correct? Now, with regards to financial reporting of lease for lessee, and then you have financial reporting of lease from the lessor's point of view. Now, there's a lot of thing to be understood here. I don't expect this technicality to come in exam. They are hardly going to ask you 1 or 2 questions from this topic. Okay. But it's very complicated. I've summarized into the table what will be the effect on the balance sheet, income statement, and cash flow for the lessee. Lessee, the one who has leased the asset, right? Correct. Now, in terms of lessee, there is also then separation of what? Of treatment is different for finance and operating lease under IFRS and US GAAP finance lease. So for all of these, there is one type of treatment. What is left? The only thing left is US GAAP operating lease. So IFRS finance and operating, US GAAP finance and operating. So IFRS, both the lease and US GAAP financing lease have same treatment. US GAAP operating have a different treatment. Now I can go in the depth of each and every component, and that will be time consuming, and it is not very important for the exam, in the sense you don't have to memorize this. All you need to know that lessee is the one whose position is like a borrower. So understand this technique. Lessee, when he takes the asset on lease, he recognizes two things on the balance sheet. On the balance sheet, he gets the asset, but he doesn't become the owner of the asset. So he recognizes what? Right of use of asset, and the lease that he's supposed to pay is called lease liability. So on the balance sheet today, asset and liability both are recorded of the same amount. Therefore, the equity doesn't change. Clear? Later on, the asset is amortized on an SLM, and liability is like a bond. It's like a debt. When you repay the liability, you pay interest component and principal component. That interest component, remember in cash flow, interest that is paid is CFO under US GAAP, IFRS is CFO and CFF. But the principal portion of the lease that you pay, principal like debt repayment, debt is CFF. It's a CFF outflow under both. Correct? And the interest that you pay is called as an expense in the income statement. So in the income statement, there is amortization of the asset, that is right of use of asset, and income interest expense is also put up. Do I have to memorize this? No, just understand this. Under US GAAP operating also, the treatment is same, just that in the asset and liability, I recognize the same thing. But in IFRS and US GAAP finance lease, the asset is amortized on a straight line basis. Here, the asset and liability both goes down by the principal payment. So the expense, which is equal to lease expense, here both are not recorded separately like the finance lease. Here, what happens? The expense is net lease, the amount of lease that you pay. That entire lease is put up into the income statement, and the entire lease is considered as a CFO, operating outflow. It's not separated. Understood? So this is more simpler US GAAP operating. Remember here one very important thing. When I say lease, which lease am I talking? I'm only talking about non-current. What is non-current? Anything which is less than 1 year or more than 1 year. What is non-current? Non-current is anything which is more than 1 year. Yes. So any lease which is less than 1 year or of low value is defined as $5,000. Any short-term lease or less than 1 year is not recognized on the balance sheet as a liability. The entire lease is considered as a rental expense in your income statement, and that is considered as a CFO outflow. If it is for short-term, or if the amount is $5,000 around. If the value is low at around $5,000, or if it is for short term, so all the contracts which are for 1 year or less, they are not recognized on the balance sheet as a liability. Understood? Correct? This is for the lessee. For the lessor, leasing is sort of an income. So what the lessor will do, if it's a finance lease, the asset will go away from the lessor. So the lessor will derecognize the physical asset and recognize the lease receivable. And here, because this is the business for the lessor, the lessor will generate some gain or loss, which will be recognized in the income statement. And during the duration of the lease or finance lease, as the lessee keeps paying on interest and principal, that is also recognized in the income statement. And in the cash flow, this is the business for the lessor. So all the money in the form of lease that the lessor gets is a CFO inflow for finance lease or for operating lease. It's a operating cash flow inflow because this is the business for the lessor. In finance lease, the lessor is going to give away the asset. In operating lease, here the treatment of finance and operating lease is same under IFRS and US GAAP. In operating lease, will the asset go away from the lessor's balance sheet? Will the asset go away from the lessor's balance sheet? No. So there is no effect on the balance sheet. And whatever is the lease that the lessor is going to get, that is considered as an income. And in the expense, all that money that is required to manage the asset, the most important, depreciation. Who bears the depreciation? Lessor. Lessor is the owner of the asset. So depreciation and all other expenses will be borne by the lessor under operating lease, because the asset's owner is still going to be the lessor owner. Clear? Okay. There is some extra information about finance lease which I've mentioned here. This is for your reference. You want, you can read it or you can skip it. I generally don't recommend people to read this. I've added it here because it's there in the notes, but you can skip it because it is very difficult to memorize. This is what I'm saying from the exam point of view. If you have time, you read it or you can skip it. Got it? Correct? Now, there are few more things, okay, which I will say you to skip it. You will read it only if you have time. Otherwise, you can skip it because it's not very, very important from the exam point of view. I've added in the notes for those who complete early and want to go in detail. Otherwise, you can skip it. Okay, it's not a priority. Similarly, in pension also, how the accounting of pension happens, this entire part, you can skip it from the exam point of view because all of this is asked in level 2. Now your question will be, then why have we added it here? That's those who want to study extra, they can. I mean, there are some people who want to know the details of it. So I've put it here. This is there in your books. I've summarized it, but it is not exam oriented. So I've written here, not exam oriented. Here also I'm writing not exam oriented. Okay. You can also write it down for your reference. Got it? Okay. Now, what they mostly asked is about the pension situation. Pension. There are two types of pension plan. First of all, pension is called a deferred compensation earned over the employee service. There are two forms of pension, DC, defined contribution, and DB, defined benefit plan. Under defined benefit, the employer promises you to make some specific payment when you retire. Under DC plan, defined contribution, the employer does not make any promise. The employer simply contributes some money into your retirement account. So can you tell me, under DB plan and under DC, defined contribution, under which of the case the employer takes the responsibility of the fund? DB or DC? Under the DB plan, under the defined benefit plan, the employer takes the investment risks because employer has promised you. Under the DC plan, the employee, me, I'm the employee, I have to take the investment risk because employer says my job is, brother, only to contribute the pension or only to contribute my share. That's it. Being a government employee, many of y'all who are in the government are employed by the government owned companies. Is the pension defined by the government? Yes, you get pension. So those who are working in government companies, they always have which plan? They have DB plan. Okay, many of them are now being offered DC plan, but DB plan is the plan which is where the employer takes the responsibility. In DC plan, defined contribution, there is no responsibility. So from the financial reporting point of view, will I report as a company, will I report any liability on my head when it comes to DC plan? No, on the balance sheet, there is no obligation. Whatever is the pension contribution is considered as pension expense in the income statement. That's it. There is no effect on the balance sheet when it's a DC plan because the employer doesn't have any liability. But in a defined benefit plan, yes, on the balance sheet, both the things are recorded in net. What do I mean by that? I'll explain you. But on the balance sheet, the liability is or the asset, either of the thing is recorded in net. I will explain you how. And pension related any changes are either recognized in the income statement or even in OCI, other comprehensive income. Remember, in other comprehensive income, in income statement, I told you there are four things. Unrealized gain or loss in available for sale, unrealized gain and loss for derivatives hedging security, changes in the pension asset and liability, and forex currency translation gain loss. So one of that was changes in the net pension asset. It is either recognized in income statement or other comprehensive income. So there is going to be a balance sheet effect with respect to pensions. Which pension? Defined benefit. Now tell me one thing. The liability for the company is the pension that it has to pay. So the plan benefit obligation or the pension obligation is the liability for the company, right? Against that liability, company has some assets, which is investments. Correct? Companies will create some asset that is investments to fund the liability. Now, mostly they will try to match. But sometimes what will happen? The liability value will be higher than asset or the asset value will be higher than liability. If the plan assets value is higher than the obligation, then we call it as an overfunded plan. Good news, right? But if the value of the fair value of the plan asset, that is your investment, is lower than the estimated obligation, then it's called an underfunded plan. Clear? Now, overfunded is an asset, underfunded is a liability. So on the balance sheet with respect to pension, if your plan is overfunded, there will be an asset recorded. But if your plan is underfunded, then there will be a liability recorded. Understood? Clear? This will only happen with which plan? Defined benefit, not with defined contribution. With respect to defined contribution, there is no effect on the balance sheet. Is that clear, everyone? Understood? Correct? Right? Okay. Now, the last section of this is share-based compensation. Share-based compensation. Employers reward their employees, right, with salary, bonus, but sometimes they also give incentive in the form of shares. This is done to align the interest of the management or the managers and the shareholders, reduces the agency cost. Agency cost means the cost to keep an eye on the managers. So they also will work for the betterment of the company because their compensation is tied to the share. Also, share-based compensation is done by the companies to avoid the cash outflow. So when you're going to give shares to your employees, you don't have to give the cash. So there's no cash outflow. This is one of the biggest reasons of share-based compensation. However, for the company, there is a disadvantage, dilution of ownership because you're issuing more shares. And they are saying that when you're giving shares, you're considering that they will align the interest, but it doesn't happen. Individual employee, even if you reward them with higher shares, they alone cannot have influence on the company's stock price. So there's no point of giving them share-based compensation because they are not powerful enough to influence influence the company share price. Also, having a share-based compensation makes the management either take too much risk to increase the compensation, or they become too risk averse that they want to secure it and they might not take the risk at all. This is the advantage or disadvantage of having a share-based compensation. Understood, everyone? Clear? Now, there are some vital terms with regards to this share-based compensation. We'll discuss that. And then there are three formats: stock grants, performance shares, and ESOPs, which most of you all are aware. We'll discuss about that. And there is something called stock-based appreciation right? That is the fourth section. We'll discuss this all four in bits and pieces in a very short form. And finally, there are some important disclosures with regards to this. This is where we complete this topic. Understood? So let us understand some important terms. So here are some important terms which might be asked in exam. Okay, they're not going to ask you any calculation here. First, what is the fair value? Fair value means basically the value of the compensation. The compensation in the form of shares that is being provided to you generally is on the market price of the stock. So whatever is the market price of the stock, that is into the number of shares that is being allocated to you, that is called fair value. Then grant date. See, very important, the date on which the stock or options are granted or given to the employees. So suppose you do a performance and based on that performance, they decide that today we grant you shares. Once they grant you shares, can you immediately sell them? No, there might be some restriction to sell. That is called the vesting period or the service period. What is this? This is basically the time between the grant date and the first receiving the time between the grant date and the first receiving the stock or exercising of the option. Means when you actually get the shares to sell it off and the day when you are allocated the shares, the time between that can be some months and can be some years also. That is called vesting period. So what happens that today I am being granted the shares, but my vesting period is 1 year, which means after 1 year only I'll be able to sell them. Okay. Such stocks which are allocated to you, but you cannot sell them are called restricted stock units. These are stock grants that do not vest until certain criteria are met. So until that time period finishes or until that performance is achieved, till that you cannot vest or you cannot sell off these securities. Those are called restricted because they are conditioned. Understood? Now, let us understand what is stock grant, what is performance shares, and what is ESOPs. Minor difference. Okay. First of all, stock grants, they are shares awarded outright right now itself without any restrictions or with restrictions? With restrictions. So the grant date is immediate, but there is restriction. Restriction means what? It is based on the performance of the share price. So you can probably, if let's say you are an employee, today you are given stock grants of, let's say, 1,000 shares. Okay. But these 1,000 shares have restrictions until you meet the performance. And what is the performance? That the company's share price should increase. Okay. So when I'm calculating the fair value, I might be calculating based on today's price, grant date. But vesting is immediate or not immediate? Well, first of all, of course, it is based on some performance, but vesting, if it is immediate, if the vesting is immediate, let's say it is for the past performance, suppose, and if it is immediate, in that case, full fair value is recognized as an expense for the company. But when you recognize an expense for the company means you issue the shares to the employees. When you issue the shares to the employee, the common stock and paid in capital, common stock and paid in capital is together is total equity. Total equity increases. But if the vesting is not immediate, let's say it's after a year or two, in that case also we do almost a similar thing, but full fair value is recognized not immediately, it is expense over the vesting period. Do I need to remember this? No. From your exam point of view, just don't get deeper into this. Just understand that vesting immediately and not immediately. If it is done immediately, recognize everything right now. If not, expense it over the period. But what is stock grant? Stock grant is where the companies are allocating you stocks for some performance. Does it impact the cash flow? Yes, let me tell you. First of all, companies issuing shares for which employee is not going to pay anything. So there is no cash outflow to the company. Understood? There is no cash outflow in terms of stock grants, right? So what happens is there is no cash outflow. So companies retain earnings reduces because it is reserves. It reduces because it is giving more money, but then the share capital gets added because new shares have come up. Overall, the stockholders' equity also remains the same. So there is no effect on equity. There is no effect on cash. Got it? Here, the difference between stock grant and performance share is that both are same. Both are same. The structure and everything is same. Just that in stock grant, they are based on the performance of the share price. In performance shares, they are not based on share price. They are based on some metric called ROE. Share price cannot be controlled by management, but ROE, return on equity, can be controlled by management. So they have one advantage and disadvantage. Advantage, it addresses the concern that a single person cannot control the share price or influence the share price. But the disadvantage is that ROE is a management number, so managers can manipulate the ROE to get the performance shares. So stock grants and performance shares, everything's same, just that the stock grants they are granted based on the performance of the share price. Performance shares are granted based on the performance of ROE, return on equity. Clear? The more common is ESOPs. Now see, in the first two cases, does the company pay any cash in stock grant or performance shares? Does the company pay cash? Is there a cash outflow for the company? No. In ESOPs, there is no cash outflow for the company, but there is a cash inflow because these are stock options. These are options given to the employees to exercise the share at not right now, but in the future. And in the future, if the company's share price goes above the exercise price, then if the stock price is above the exercise price, then it is profitable for the employees to exercise the option. So I don't know whether they will exercise or not. Therefore, deriving the fair value is highly subjective here. And we do it not on the basis of market price, but we do it on the basis of option pricing models, which we study in derivatives called Black and Scholes or binomial model. Black and Scholes is part of a level 2, not level 1. But do I need to know how it is done? No, just you need to know that the names, that is option pricing models, are used in ESOPs. Why? Because whether the option will be exercised or not, I don't know today. Now, in the first two cases, company doesn't have any cash outflow or inflow. In ESOPs, if the ESOPs are exercised, company does receive the cash inflow. Very important. Okay. But is the stockholder equity affected? Stock grants, like stock grants, stock options, also overall stock equity remains the same. As the expense reduces the retained earnings, so the retained earning goes down. But here, very interesting thing happens under stock option, that the cash of the company increases and the stockholders' equity will also increase if exercised. So if exercised, yes, if exercised, cash and equity both will increase under ESOPs. This doesn't happen in stock grants. Got it, everyone? Then there is a small discussion in your notes about stock-based appreciation rights. In this case, if the stock performance increases, the company doesn't issue shares. The companies give cash if the stock's performance increases. It's opposite to stock grants. In stock grant, if the company's performance increases of the share price, more shares are given to you for free. Your shares are not given, cash is given. So there is a cash outflow, but it avoids dilution. Correct? Here, how to measure the company's stock performance? Well, if it is listed, great. If it is not listed, then you take some other company which is similar to my company and check its performance as a benchmark. That is called a phantom stock. For example, if ADNOC is not listed, I will take Saudi Aramco's performance and accordingly judge your performance. Why? Because my company is not listed. Such a stock is called phantom stock. Got it? Hypothetical stock. Conclusion. Can you tell me, when the company gives compensation in the form of stock grant or performance share, is there any cash inflow or outflow? No cash flow, neither inflow or outflow, right? Am I correct? Yes or no, everyone? But when the company issues ESOPs, there is a cash inflow. When the company gives stock-based appreciation rights, there is a cash outflow. Is this clear? All the four different types of compensations. Everyone understood? Now, here are some of the important disclosure with regards to leasing, pension, and stock-based compensation. First, I'll discuss stock-based compensation. Well, I need to know what is the nature of the plan and the details, like vesting date or grant date. I don't need the price. I need the vesting date and the grant date. When can I vest it? When will the shares or options be allocated to me? How is the fair value determined? Either you determine it from the current market price, or in case of ESOPs, you use option pricing model. And what is the effect of these on your EPS? Remember, we calculate diluted EPS. Whenever there are ESOPs, whenever there are stock options, if they are exercised, EPS will dilute. Am I correct? So we need to see that effect in the income statement, and which we definitely see in the form of diluted EPS. Everyone with me? So this information is also presented. Clear? With regards to leasing and pension, what are the disclosures? Well, some common disclosures are in terms of leasing, the depreciation expense by the class of underlying asset. Yes. Who will recognize the depreciation? The lessor. Understood? In case of operating lease. Maturity split between current and long term. Yes. Current and long term. What is a current lease and what is more than 1 year? Maturity analysis of lease receivable under IFRS. Here, at minimum must show undiscounted lease payment to be received in each of the next 5 years and aggregate demand beyond 5 years. Very, very crucial. So in IFRS, okay, what you need to see, rest everything is common. Maturity split between current and non-current is common between IFRS and US GAAP. But in IFRS, which is also called International Accounting Standard, we need to display as lease receivable. The lease receivable, that means for the lessor, a minimum of undiscounted lease payment that you're going to receive in the next 5 years, each year's data I need, plus the total I need, aggregate amount I need for beyond 5 years. So let's say if your lease contract is for 10 years, the next 5 years estimated lease I need that information, and beyond 5 years, whatever number of years you have, you need to give me a lump sum number. This needs to be added in the disclosure. This is a rule. In case of pension, we need to know what type of pension plan it is, DB or DC, and the pension obligation is an estimated number. How much will be the pension? That is based on how many people will join, when will they retire, how many years of service they will have, what will be their last salary, and how will the pension be calculated. All of this is estimated, and if any of the estimations change, any of the assumptions change, then your pension obligation will also change. Therefore, we require a sensitivity analysis of all the assumptions used in the pension calculation of obligation. Clear? Sensitivity analysis means we need to present multiple scenarios as to what can happen if this changes, if that changes. Got it? Clear? Very complicated. It's not that easy topic. Okay. So let us do some questions related to it, everyone. This is, again, I'll repeat, lease, pension and stock-based compensation is what we have in this topic. Clear? Okay. Bonds, fortunately, they've removed it. Good. Which of the following is least likely included in the disclosures of share-based compensation? We just saw. How the fair value at the grant date was determined? Do we need it? Yes, we need it because we need to know whether it is based on fair value or whether it is based on option pricing model. Impact of share-based transaction on balance sheet. Share-based transaction on the balance sheet. Do we need that? Yes, we need the impact not only on balance sheet, but on income statement. And share price at reporting date. Do we need something like that? Did we study something like that? No. Understood? Clear? Next. The least likely reason for corporation to lease rather than buy. What is the reason to lease rather than buy? You have to find the least likely. Decreasing its financing cost. Yes, one of the reason is to reduce the financing cost, leasing. So this is not the answer. You're looking for least likely. Benefit from appreciation in the assets value. Is this the reason for leasing? No. Conserve cash, which means down payment. Yes. So the answer which is incorrect is B. Remember, least likely means you're looking for the incorrect answer. Am I correct, everyone? Good answers, everyone. Next. A lease is most likely to be reported as finance. Remember, there are 5 conditions. Any of the condition you meet. The lessor would otherwise operate the asset in a normal course of business. We didn't study anything like this. The present value of the lease payment is less than the asset's fair value. No, it should be more than the asset's fair value, not less. So this is wrong. Ownership of the asset transfers to the lessee. Yes. So condition number 3 is in fact the first condition, right? Either it should be transferred or the lessee should have the choice to buy the asset and he or she exercises it. Correct. Next, which of the following must both the lessee and the lessor disclose in IFRS? Yes, both of them should disclose. Restriction and covenants imposed by the lessee. See, lessee and lessor both. Maturity analysis of future payment, right? Maturity analysis. See, in terms of lease, maturity analysis is needed, right? Of lease receivable under IFRS is needed, but it is needed for the next future payments of the lease, right? Interest expense included in the income statement resulting from the lease. Is interest expense always included in the, see, interest expense is only for the lessee, not for the lessor. They are something that will come up in lessee and lessor both. So whether it is lessee or lessor, whatever is the lease payable in the next 5 years and later is compulsorily to be reported. So that is called maturity analysis of the future payment. That is compulsory. This is not so easy one, but yes, whether the whatever is the lease payment to be done in the next 5 years and beyond, that has to be reported by the lessor as lease receivable, by the lessee as the lease paid, lease to be paid. Both of those have to be reported. Understood? Okay. I rarely expect the disclosures to come, but if they do come, then whatever we've written, you only read those disclosures. There are a lot of other disclosures in your book. You can't even memorize them. So no point of going through that. Okay. Next, an employer offers a defined benefit pension plan and a defined contribution pension plan. The employer's balance sheet is most likely to present an asset or liability with DB or DC or both. See, asset or liability will only come in the form of DB plan, defined benefit. DC plan, there is no asset liability recorded. Am I correct, everyone? Clear? Got it? Yes. This is the end of the second biggest topic, that is the discussion of non-current asset or non-current liabilities. Correct? Now we move on the discussion of taxes. Taxes is relatively now a shorter topic. Mostly they ask you the calculation of either a DT or DTL, and some theoretical questions they ask you on valuation allowance or the changes in taxes. So taxes, which was previously a headache for many students, now I'm not saying it's not a headache, but it's relatively lesser. Got it, everyone? So let's begin with taxes. Okay, yes. Now, before I jump up into the taxes, remember there are two types of reporting. One is financial reporting, which is based as per IFRS and US GAAP, correct? This is done for investors and creditors and so on. Second is tax reporting, which is done to your local authority. This will define how much tax you actually pay. Understood? Are they both always same? No, they both are not always same. Now, due to this, there might be some difference. Before I hit on those differences, we need to understand what are the terminologies as per financial reporting and as per tax reporting. Financial reporting, what we call as profit before tax, earnings before tax. Earnings before tax is what we call as accounting profit in FR, taxable income in TR, tax reporting. Guys, these terms are very important. What do you call them in financial reporting? What do you call them in tax reporting? Okay. The amount of tax that you see in the income statement, as per the financial reporting, we call it as income tax expense. As per the tax reporting, we call it as income tax payable or simply taxes payable. Clear? Similarly, the balance sheet value of asset and liability, in financial reporting, we call it as carrying value. In tax reporting, we call it as tax base. Everyone is comfortable with these terms. These terms you need to remember. They are called differently in financial and tax reporting. In exam, they will use these terms. Understood? Correct? Okay. Now, what creates a DTA or DTL? Okay, DTA, deferred tax liability, and deferred tax asset, DTA and DTL. Deferred tax means you will pay more tax in the future or you'll pay less tax in the future. There will be a tax benefit or a tax loss. Okay. That is what we are going to understand in DTA and DTL. Correct? So DTA, DTL, DTA, DTL. First of all, we need to understand when the DTA or DTL is created. There are two ways of calculating it. I'll show you both how it is done. But your focus should be on taxes payable. This should be your focus. Everyone with me? Now see, which is the actual tax that you are going to pay as per the tax reporting, right? Correct? Not as per the financial reporting. The actual tax that you're going to pay is as per the tax reporting. Financial reporting, you do it based on the accounting standard. Now, what if the taxes payable right now are more than the tax expense that you showed in the financial reporting? So actually you paid more taxes now, and this difference is temporary. So if you pay more taxes now, as per the tax reporting, compared to the financial reporting, in the future, you'll pay less. I'll repeat, if you pay more taxes now, in the future, you'll pay less because this will all reverse. It is temporary difference. All this is temporary difference. I'll repeat, DTA or DTL is all temporary difference and it is expected to reverse in the future. That means if right now I've paid more taxes, in the future, I'll pay less. Is that a benefit or loss? If right now I paid more, in the future, I'll pay less. That's going to be a benefit in the future, right? So benefit in the future means it's an asset. It's a DTA. Understood? Similarly, if the income tax payable right now are less, so right now you're paying less, you'll pay more in the future. That's not a benefit, that's a loss, and hence it's a DTL. Understood? Clear? This is how you remember. You need to ask 4 questions. Either the income taxes payable are more or less. If they are suppose more, that means right now you've paid more taxes, in the future you'll pay less. This is a benefit, hence it's a DTA. Similarly, if the income taxes payable right now are less, in the future you'll pay more. I call my students, this is like karma. Right now you pay less, in the future you'll pay more. You'll pay more, that's a loss, that's a DTL, deferred tax liability. Anything that will make you pay in the future, it's a liability. Correct, everyone? Understood this technique? Clear? Now, there is another way also, which you need to know about the asset. Suppose the asset's value on the balance sheet, that is called tax base, and the assets value on the financial reporting, which we call as carrying value. Remember this? Carrying value and tax base. Now, I want entire class to imagine. Suppose there are 2 different types of depreciation, SLM and double decline. Correct? Let's say in the first year, under tax base, I have double declining depreciation, and under financial reporting, I use SLM. Where do I have more depreciation? In the financial or tax reporting? In the tax reporting, initially, right? I have more depreciation means my profits right now will be less. If my profits are less, my taxes right now will be less. Understood? Correct? Right now, less means more in the future. Hence, it's a DTL. So let us understand this. So see, if the depreciation is double declining, what will happen to my tax base will be lower compared to the carrying value. My tax base will be lower compared to the carrying value. This tax base being lower than the carrying value, that means because I charge more depreciation in the tax means less profit. Less profits means less taxes. So right now I paid less taxes. I'll pay more in the future. Hence it's a DTL. What if the situation was reverse? What if the situation was reverse? What if it was SLM in tax and double declining in financial reporting? That means in tax reporting, my depreciation was less my tax base of asset was more. So my depreciation was less, my profit was more, and I paid more tax now, less tax in the future. Hence, it's a DTA. Correct? Everyone? Understood? Now, remember DT and DTL, as I said, both are temporary, means they have to reverse. If they are not going to reverse, you cannot recognize a DT or DTL. Also, on the balance sheet, DTA and DTL both might be present for different purposes. So they are not netted off like pension. In pension, you don't report pension liability and asset both. You only report the net. In DT and DTL, both are reported on the balance sheet separately and are not netted. Are you with me? Correct. IFRS considers DTA and DTL as non-current asset and liability, which we saw in the calculation of cash flow. US GAAP puts up in both current and non-current. Whatever is something that is going to be settled in the coming year, it is current. Beyond that, it is non-current. For your exam, you need to focus that DT and DTL are both generally non-current. Understood? Clear? So, generally, in order to calculate DT and DTL, there are two ways. See, one is the difference between income tax expense and income taxes payable. This, see, I'll tell you, the method to calculate DTA and DTL are two. First of all, the difference between income tax expense and income taxes payable. Payable is as per the tax reporting, is due to DTA and DTL. See here, I've put up in the notes behind. Income taxes payable plus change in DTL minus change in DTA. Plus change in DTL minus change in DTA. This we will understand in a moment, but you need to understand that the difference between income tax expense and income tax payable is due to DTA and DTL. This is one way to calculate. The second way, which I want you all to write, is that the difference between carrying value and tax base, whatever is the difference into the tax rate, is your DTA or DTL. Understood this? Clear? Have you written this? Got it? Okay, this will help you calculate. But to identify DT or DTL, you need to check the taxable income taxes payable and income tax expense, and only then you can know. Or you can check the tax base of asset and carrying value, only then you can say. Correct? For example, tax loss carry forward. What is tax loss carry forward? Whatever is the loss in the current year, you can utilize that to reduce your taxes in the future, isn't it? Correct? So in the future, your tax will increase or decrease because of tax loss carry forward. In the future, your taxes will increase or decrease because of this benefit. Your taxes will decrease. So anything which causes your taxes to decrease in the future is a DTA or DTL. Well, it's a DTA compulsory. So whenever you see tax loss carry forward, close your eyes, blindly say it's a DTA. Correct? Both of them should be, DT and DTL should be temporary in nature. Temporary in nature. But what if they are permanent? What if the difference is permanent? Then can I recognize it as a DT or DTL? No. No DTA or DTL can be recognized if the difference is permanent. Now, what will cause a permanent difference? Permanent difference can be due to some policies of the government that some items are allowed to recognize as tax or some are not allowed. For example, fines and penalties, they are not allowed for, they are not allowed to claim as an expense for tax reporting. But financial reporting might allow it. Second, you might receive some tax credit. What is tax credit? You might not pay tax for cert or tax credit, or you might get some tax holiday. In such case, you might not pay tax for either forever or for certain period. Now, if anything which leads to the difference in taxes forever, it's a permanent difference. Whenever there is a permanent difference, we don't record a DTA or DTL. For example, if you open up a company in free zone in UAE, UAE has free zones, then you will never pay tax compared to the financial reporting. So you'll actually never pay tax until there is in the free zone, there is no tax policy. So this will be permanent difference. Hence, no DT or DTL is recognized. But how do I identify whether it's a permanent difference or not? Well, you need to compare two things, effective tax rate and statutory tax. Statutory tax rate is the tax rate decided by the government. For example, let's say the corporate tax rate in many countries is 30%. In some countries, which they have recently introduced, is around 9 to 10%. In many countries, there's no corporate tax also. So it is decided by the state. That's why it's called statutory. But effective tax rate is the tax rate that you actually pay on your pre-tax income. So whatever is your pre-tax income, on what is the tax as per financial reporting, that is income tax expense, that is called effective tax rate. It is the tax rate due as per the financial reporting on EBT. EBT, that is pre-tax income. When these two do not match, it is called permanent difference. For example, the state says that the tax rate is 30%, but I got some tax benefit because I opened a factory in a remote area. So I got incentives from the government. So this difference will stay forever. It will never reverse. The effective tax rate of mine might be lower, correct? Therefore, this permanent difference will not cause DTA or DTL. Don't worry, you don't have to calculate anything in exam. All you need to know is this, that they will cause permanent difference. However, I've seen many questions related to effective tax rate. Effective tax rate is nothing but the income tax expense in your financial reporting. That is what you do when you calculate EPS also, divided by pre-tax income. That is your effective tax rate. It is actually the tax that you end up paying on the pre-tax income. Clear? Right? But we don't pay the current year tax in the same year. We pay some taxes this year, some taxes next year. So the cash taxes paid might be different. That is based on the cash taxes over the pre-tax income. This is not important for you to memorize, but these two you need to know properly. Understood? Especially effective tax rate. Clear? Right? What if the tax rates increase or decrease? Well, if the tax rates change, DTA and DTL both will change. For example, if the tax increase, DTA and DTL both will increase. What do you want to increase? You want the DTA to increase or DTL? Well, you want DTA to increase. If DTA increases, that's a benefit. And if there is a benefit, what will happen to your income tax expense? It will go down. But if the DTL increases, it's a loss and your expenses will go up. Similarly, if tax rate goes down, DTA and DTL both will go down. DTA, which is an asset going down, is bad. So your income tax expense will increase. But if DTL, your liability goes down, it's a good sign. So your income tax expense will also go down. Correct? Understood? Now connect that with the formula. If the change in DTL, see change in DTL, what will cause income tax expense to go up? If the DTL increases, your income tax expense will go up. That's why we add it. But if the DTA increases, your income tax expense will go down. That's why we put negative. Understood? Clear? Got it? Okay. Now suppose your company has a DTA of $100 and DTL of $80. Old tax rate was, let's say 40%, and new tax rate is 50%. So with regards to this, DT and DTL both will increase. What will be my new DTA and new DTL? See, my new DTA will be old DTA. How much is old DTA? 100 into the new tax rate over the older tax rate. New tax rate over the older tax rate. What is my new tax rate, guys? New tax rate is how much? New tax rate is 50 over old, that is 40%. 50 over 40. Same way for DTL, it was 80 into 50 new tax rate over old tax rate. New tax rate over old tax rate. This will definitely increase my DTA and DTL. So my DTA will be, my DTA will be 100 into 50 over 40, that will be 125. And DTL will be 80 into 50 over 40, that will be 100. So my DTA has increased by 25, my DTL has increased by 20. Since I had DTA more, my income tax expense will decrease by 25 and increase by 20. So the net effect will be positive, that my tax expense will go down only by 5. The net difference is 5. Understood? The net difference is 5. Clear? Why 5? Because see, your income tax expense will go up when the DTL goes up. So it will go up by 20. But if the DTA goes up, your income tax expense will go down by 25. Overall, your income tax expense will go down by 5. That's a good sign. Why? Because you had DTA more. Understood? Clear? So DTA is an asset or liability, guys. Everyone, we know DTA is an asset. Remember, in the long-lived asset we discussed, actually DTA is a part of long-lived asset. When an asset's carrying value falls, when an asset's recoverable value is below the carrying value, means the carrying value is much higher. What do we do? When the asset's carrying value is higher than the recoverable amount or recoverable value, what do we do in that case? Do you recollect something we did? We did impairment of asset. When the asset's carrying value is higher and its market value is way below, we do impairment of the asset if it's a long-lived asset. Understood? Similar concept we did in inventory called write down of the asset. Here, with respect to DTA, what is your expectation about DTA? Your expectation is that in the future, when the time comes to pay more taxes, I'll get the benefit and I'll pay less taxes. Correct? Right? This is called reversal of DTA. What is reversal of DTA? That you will get the benefit of paying, you'll get the benefit in the future year. So when you'll have to pay taxes, the past circumstances will give you the benefit that you will have to pay less taxes. However, what if there is no profit by the company? So I cannot take the benefit of DTA. If there is no profit, there is no tax. So I cannot set off my taxes because there is no tax itself, because there is no profit for the company. So if the company has no profit, there will be no taxes. In such a case, I will not be able to utilize the DTA. This is called DTA not reversing. So when the DTAs do not reverse, we recognize a loss in the income statement called valuation allowance. Valuation allowance. The fall, what we saw write down or impairment before. Similarly, for DTA, we call it as a valuation allowance. But remember, valuation allowance is a term only used in US GAAP. IFRS doesn't use this name. It does the similar treatment, but it doesn't use a name. So valuation allowance, it means the DTA on the balance sheet will go down. And why does this happen? This happens because we expect DTAs will not reverse. Understood? If there is any doubt, then the carrying amount should be reduced by the recoverable amount. So we should scale down the amount like impairment or write down. However, this process is called valuation allowance. But remember, valuation allowance is a term only used in US GAAP. IFRS doesn't use the name. It has a similar treatment, but doesn't use the name. So the name valuation allowance is related to US GAAP only. But what if later on the circumstances change? Then the DTA may be reversed. Okay. But see, like impairment write down, DTA going up, down, all this, who will decide? Management. And all of this is subject to judgment. So whenever a company reverses the adjustment of DTA, it becomes a question mark to the analyst. Analyst gets worried about the company. Why is the company doing it? Are they doing it to manipulate numbers or not? So All these subjective things, impairment, write down, DTA, valuation allowance creation. Sometimes companies deliberately do the valuation allowance. Why? Because not only the asset value will go down, but your income will go down. Because your expenses will be higher, your income will go down. If your income goes down, you pay less taxes. So sometimes managements deliberately do that so that they pay less taxes now, and later on they can show higher profit when you reverse it. So right now you create valuation allowance, you show it like a loss. Later on you reverse it and then show higher profit. So managements time out this thing. The managements time out this thing to show better results or save taxes. Therefore, it's a warning signal. If a company is deliberately doing this, it's a warning signal. Correct? This is about DTA if it doesn't reverse. But what about DTL? DTL is a liability, right? If the liability does not reverse, good thing or bad thing? DTL means you had to pay more taxes in the future. If the liability will not reverse, is this a good thing or a bad thing? Everyone? Well, if the liability is not going to reverse, it's a good thing, right? You will not have to pay anymore. So they are saying if DTL is not expected to reverse, what am I supposed to do? You have to treat that DTL as equity. Means the DTL will be reduced and should be taken directly to the equity. Why equity? Because there was a loss which I had to pay, but now I don't have to pay anymore. So this amount is taken into equity. Remember, DTA, if it is not expected to reverse, you create a valuation allowance. But DTL is like a liability. If it is not expected to reverse, take this amount directly to equity. Is this clear? This is very, very important. I've seen this coming up many times, right? Some of the disclosures have been put here. Okay. For example, deferred tax liability, valuation allowance, and net changes in the valuation allowance disclosure we need because we don't have this information. Unrecognized DTL or undistributed earnings of subsidiaries. Now, this you can't memorize, but any subsidiary related DTL which is not yet recognized, all those need to be disclosed. Current year tax effect for each of the temporary items, components of the tax expense. How is the tax expense derived? Tax loss carry forward and tax credit that you might have received in the past, and the difference between income tax expense as a percentage of pre-tax and statutory. Why? So that you get to know whether it's a permanent difference or not. If it's a permanent difference, you can't recognize a DT or DTL. Finally, as an analyst, what should I do? Very, very important for your exam. Very important. This. When differences are expected to reverse and result in the future tax payment. So if DTL is expected to, if the DTL is expected to reverse in the future, if it is expected to reverse in the future, treat it like a debt because you have to pay a liability, right? Include that in the leverage ratios also. But if it is not expected to reverse, no future tax payment will be there, then treat that DTL as equity in the leverage ratio. So suppose if you're calculating debt to equity ratio and you have a DTL, if it is expected to reverse, add it to the debt. If it is not expected to reverse, don't add it to the debt, add it to the equity. Understood? Everyone in the class, this was the most important point. Okay, let's do some questions with regards to taxes. Everyone with me? Correct? Right? DT, A and DTL calculations. See, in this topic, DTA, DTL calculations and theory is mostly asked. Some calculation will be there and mostly it is going to be theory. Let us do some of the variety of the questions. A firm sold 530 units during the 1-year warranty. The firm estimates that 20% of these units will have claim. So out of 530, 20 units will have a claim. Okay, 20%, sorry. On them during the next year, costing the firm $80 per unit. So if 20% come back at $80 per unit, how much will be the claim? I will do 530 into 20% into 80 per unit. The claim will be 8480. Got it? Now they have said, in a country where firm operates, warranty expense is not tax deductible until it is performed. Means in the tax reporting, I will not put the warranty unless actual there is a claim. Here they are saying the claim will happen the next year. So in the tax reporting, can I report it? In the tax reporting, will I report anything? No. They have asked, what is the tax base? Tax base means what should I report in the tax? In the tax part. Will there be any liability in the tax reporting in the first year? No. In the tax reporting, it will appear only in the next year. In the financial reporting, it will appear right now. So will there be any tax amount, tax base? No. It's a very, very trick question. The answer is 0. Why? I'll repeat. Because in the tax reporting, we do cash-based accounting. We don't do accrual accounting. So they said that this warranty claim will come next year. So in the tax reporting, the current tax base of this liability will be 0. In financial reporting, I will put this amount. But they ask tax base. Tax base is tax reporting. Tax reporting, nothing will come in the first year. Understood? Clear? Very important question. Got it? Everyone? Next. If timing difference that gives rise to DTL are not expected to reverse. Remember, if DTL is not expected to reverse, we treat it as very easy, very easy. We treat it as equity, isn't it? Should be considered valuation? No, that is for DTA. No, should increase the equity. If DTL is not expected to reverse, we consider that as we add that to the equity. Very good. Everyone, nice. Company has a DT of 300,000 and a DTL of 450 based on a tax rate of 20%. If the tax rate increases to 25, what will be the change? Or first of all, what will be my new DTA? My new DTA will be old DTA 300,000 into new tax rate over old tax rate into 25 divided by 20. My new DTA will be 375. And my new DTL, both will increase, right? If tax rate increase, both will increase. It will be 450 into 25% divided by 20%. That will be 562. Am I correct? No, sorry. Tax liabilities 450 to 25 divided by 20. Yeah. 450 into 25 divided by 20. I'll get 562.5. Correct? What is the change? So the change in DTA and change in DTL, DTA has changed by 75,000 and DTL by 450 by 112,500. So increase in DTA will decrease my income tax expense, but increase in DTL will increase my income tax expense. So what is the net effect? Minus 37,500. That will be my increase or decrease? That will be my increase because I have liability more. Isn't it? Or decrease? So if they say income tax expense, it will increase. They said what will be the most likely impact on the income statement? They did not say income tax expense. They said income statement, and in the solution, they've said net income. Had they said me income tax expense, is the income tax expense going to increase? Yes, but not by 237,500. So the net income, if the income tax expense increase, net income will go down by how much? 37,500. Very tricky question. If they say net income will reduce, income tax expense increase. Why? Because I have DTL more. You can also use the shortcut. You can just take the difference between both 450 and 300. That is 150 into 25 divided by 20. Directly, you will get the answer. 150 into 25 divided by 20. You'll directly get the answer. But then that will be the net effect. Whatever is that net effect, that you can directly, that difference into the net effect, you can directly put up into the answer, either DT or DTL. Correct? Some people do that. it's better you calculate both separately. So you can calculate both separately and see what is the change and accordingly put the effect. Correct? Remember, if income tax expense goes up, net income goes down. Clear? Next, which of the following ratios, financial ratios, is least likely affected by the classification of taxes as liability or equity? Means in which of the ratios below there is no effect of liability or equity? Leverage ratio has debt equity both. Return on asset has net income and total asset. It doesn't have debt or equity, right? Return on equity has equity. So which ratio will be unaffected? Least likely to be affected is B. B. Everyone understood? Correct? Clear? Got it? Right? Okay. Next, while evaluating the financial statements of Omega, the analyst observes that the effective tax rate is 7%, which is less than statutory tax rate. Guys, tell me, when the effective tax rate and statutory tax rate do not match, it's a temporary difference or permanent? It's ideally a permanent difference, right? Correct? It's generally a permanent difference, right? Okay. But they said the source of this difference is determined to be a tax holiday. It's not a forever tax exempt. It's a tax holiday, which is temporary. Okay. On a manufacturing plant located in South Africa. So, guys, if they use this word tax exempt, it's forever. If they say tax holiday, it is not forever. It is permanent. So it is not permanent or forever. It is temporary. So what should I do? The item is most likely to be continuous in nature, so the termination date is not relevant. First of all, tax holiday is not permanent or continuous. It might be for limited period. We don't know about it. So they are saying it is most likely to be sporadic in nature. What is sporadic? Sporadic means occasional, temporary. And analysts should try to identify the termination date and determine if taxes will be payable at that time. Termination date means what if the tax holiday is going to end up in the couple of years? And after that, you might have to pay. Yes. If that is the case, then you might have to record a DT or a DTL because then it's a temporary difference. This is the answer. But the effect is typically neutralized by higher income. No. Of repatriate profits and taxes. This is not the answer. So we need to identify whether it's a permanent or a temporary difference. Tax holiday, remember, is a temporary difference. And we need to see whether this difference, when will this tax holiday terminate? Because if it is going to terminate, then it will reverse in the future. And therefore, it's not a permanent difference. Understood? This clear? Quite a intense topic. Clear? Well, this is the end of your income taxes. Now we have financial reporting quality, which is a theoretical discussion. Then you have financial analysis techniques, which is all about the ratios. Most of the ratios we have already covered. I will highlight upon some of the important ratios there. And after that, you have the topic of financial modeling. Financial modeling will be there in your topic, right? Which is a short topic. Okay. So this is what we are left in terms of financial statement. Clear? Got it till this point, everyone? Understood?